Hello and a very warm welcome to Big Deal. In US President Donald Trump's words, we don't need Chinese virus. And going by what India is poised for, we don't need Chinese funds either, it seems. It's been a few months of FDI restrictions on neighboring countries, essentially China. And there are already alternate investors emerging, like Sequoia Capital, with 8 investments in Indian unicorns, leaving behind the dominant Chinese investors like Tencent. To discuss the startup life sans China, we have with us a panel of well-known venture capitalists. Let me welcome on the show Sudhir Sethi of Chirate Ventures, Karthik Reddy of Bloom Ventures and Gopal Jain of Gaja Capital. Gentlemen, welcome to CNBC TV 18. And let's start by addressing the dragon in the room. Sudhir Sethi, what has been the damage that has been caused because of the restrictions on Chinese investments in the startup space in India?
So I think we may want to slice the markets. As far as early stage and seed stage investing or capital was concerned, the Chinese investments were not significant at all. So there is no damage there. Of course, the companies who had term sheets from Chinese investors, those are most affected. And as far as late stage capital is concerned, there is, especially because of geo and other things in the last 5 months, we've seen a substantial amount of capital which has come in from non-Chinese investors. So effectively, to my mind, the overall market, specifically where term sheets were there, will feel the pinch. But otherwise, I think in a medium term, I don't think there's big issues at all overall.
Right. So, Sudhir, I will just counter you on one aspect that probably the geo platforms investments and the big investments at that were concentrated in one company and maybe an aberration in the positive way. But Karthik, coming to you, on this very aspect, so far the threshold has not been defined when it comes to the FDI restrictions that the government had come up with. And everybody, the street, has been waiting for those clarifications. So far, any Chinese investor with even one share who is domiciled in China really is the one who needs more approval. What are the kind of clarifications that the street is expecting from the government?
I think there have been some hints. Unfortunately, the geopolitics has further confused the timing of this. But eventually, I think we'll get there. I think the government, in the early few weeks, even as Gopal and I are in the executive committee of the IBCA as well, when we were having dialogues with them, they were very open to the idea that, look, we're just putting safety rails here. We're not trying to block anything significantly. And I think there are two ways to look at, adding to what Sudhir said, by the way, there are certain spaces in which they play. So firstly, I think they do affect the market, but not more than 20% maybe of the universe, and that too predominantly in venture, even lesser in private equity. And then within that, therefore, then there are various players who are material. Some of them have Chinese affiliations, but are not really domiciled or raise their capital in China. So pooled vehicles cannot be seen in the same fashion as strategic Chinese capital sitting in Beijing or Shanghai, right, or Hong Kong. So I think pooled vehicles, we expect pooled vehicles to have a little bit more of freedom as long as they're 20-25% of the capital or less is from Chinese or Hong Kong shores. And we expect up to about 10% ownership of most private companies to be sort of automatic approval, even if they are from those shores. The idea is, do they control anything in India? Are they a threat? Can they make an aggressive takeover bid? I think these were the concerns of the government. I don't think the intent was to allow for free flows of capital into the economy. So this is what we expect when that announcement does come through.
All right. So the geopolitical tension has also probably scuttled any such clarifications from coming from the government. But this is the new normal, and living with this, Gopal Jain, Sequoia Capital has been the top investor in some of our unicorns. So is there enough alternate pool of capital making its way to the startup space where Chinese can be really outplaced over there?
Thanks. First of all, let me clarify, because I'm going to make a couple of strong statements. It's important for me to clarify that we are a growth investor and we don't have any Chinese LPs. And the reason I think it's important to clarify that is because I'm going to take a stand that uh, these measures are halfway measures. And unless and until we follow through on these measures, our venture capital and private equity ecosystem is going to be significantly affected. Chinese capital was the largest source of capital into the venture capital ecosystem. Yes, the venture capital ecosystem is only 25% of India's broad private equity ecosystem, but it's the nursery of all companies. Today, 100% of our deal flow comes from the venture capital ecosystem. Secondly, the way to think about this measure is not to now start thinking in terms of, American capital or European capital. That is not a long-term sustainable measure. Given a step of this magnitude, what we need to do, the necessary second half of this step, is to follow it up with measures that create a domestic source of capital. We are the world's fourth or the fifth largest economy, and we are painfully dependent on global capital for our venture capital and private equity industry. How long can this last? And how long will we go running from post to pillar? That now Chinese capital is out, let's start looking for American capital. Then tomorrow, American capital will be out, and we'll start looking for European capital. We need to follow up on this measure by taking some simple, clear steps that create domestic sources of capital. We need that. We need to substitute that Chinese capital. If we don't substitute the Chinese capital, our entire venture capital and private equity ecosystem will be affected.
Right. So domestic pool of capital and, the public and the private markets are very different, gentlemen, right now. Can there be a parity? Is this India's opportunity to bring about that parity and depth of fund for the public as well as private capital at par? Sudhir Sethi, why don't you answer that? What are these pools of capital in the domestic market which can be tapped for the startup and the tech investments?
So first, I agree that I think the unleashing of rupee capital is very important. I mean, we've also benefited by that. 50% of our capital comes from India right now in the venture space, fund by fund. Now, there is one large pool of capital, which is family offices, which is in maybe $2 trillion. Second is insurance. Third is provident fund. So I think there's very large pools of capital. There's also corporates, CBCs. I mean, just to give you an example, just the top 10 IT companies in the country, in dividends and share buybacks in the last 10 years, the total amount of capital spent was $35 billion. And all of that, obviously, for shareholder wealth creation was very important, but I'm sure, even 10, 15% of that going into risk asset class venture, which creates new companies, was very, very important. So I think it's very, very crucial that these pools of capital be released. There's some tax parities which are important, those be addressed. And I don't think we have the luxury to wait. We, you know, all the data is with the government. I'm sure IBC and other bodies have provided that. I think we should do this in a hurry. The total amount of rupee capital in private equity and venture capital put together is definitely not more than 5 to 10%. It needs to go up to something like 30, 40%. And the faster that action is taken, the better it is.
Right. So we have to really work towards a speedy, investment kind of a climate in India itself. But Karthik, help us understand what is happening at the ground level. The companies which were waiting with term sheets from China, what is happening there? And are now companies really looking out for more avenues of funds, and are they getting it? What's really happening on the fundraising transactions bit?
We obviously engage a lot with much younger startups, given the stage at which we enter and the few rounds that we see them through. And one of the core characteristics is to be nimble and be survivors irrespective of the environment. Right? It's not about COVID or Chinese capital. This could be a situation they face even in a regular year. So I think that's the DNA of the firm. So one is that they're phenomenally adaptable. I think if you have a perfect storm against you, there's not much you can do. And I think if you're a good founder, you'll figure out how to get, find a home for the business, be thoughtful and get an M&A done. So if you're a travel company which had $1 million in the bank and you were hoping to raise around this year to be able to grow, then you're in a perfect storm situation, right? You don't have anyone looking to invest in you, irrespective of the source of capital. Industry is like dead in the water for about a year, and then you can't keep the lights on in terms of your team, etc. So I'm just taking that extreme example, but the ones who did have Chinese term sheets or do already have Chinese investors on the cap table, both would be approximately in the same boat, because essentially then you're dependent on your existing investors sort of rescuing you and propping you up at this point in time, or you are hoping that, I was just a month or two away from capital coming from the eastern side of the country, and suddenly with those roadblocks, you have to adapt rapidly. And I think, you saw the Zomato rumored announcement that they're potentially getting money from Temasek. You saw, more capital coming into Dream 11. So I think people, everyone from the unicorns to the early stage companies will adapt. There's far more to lose in the unicorns, so they will get protected by the cap table collectively as quickly as possible. And the younger companies, some might suffer, but if you hadn't started raising, then I don't think it's an excuse, because you're going into a market with conditions known, right? And it is not a year where Chinese or American, you could just sit here and hope that they would all come in. There are no flights coming in, right? You're restrained, constricted, or by your domestic market, or managers sitting inside your domestic market, even if they're managing overseas capital. And I think that should be the bulk of source of capital along with your existing cap tables to make this 15 to 18 months work. And then, if you're playing into tailwinds, I think by mid-2021, you'll be a very well sought after company. So that's the general rule of thumb, and that's the advice we've been giving most of our companies.
All right, so we have a long road ahead, but Gopal Jain, I mean, what is the fate of the companies which have huge investments from these Chinese investors? Like very recently, Dream 11 had to emphatically clarify that Tencent is a very small minority shareholder. Is that going to be the fate for many such companies? And what happens to the ones which are hugely, has seen huge investments from these Chinese investors?
The real question is not these 30 odd unicorns. The real question is who's going to create the next 100 unicorns. So Marta kya nahi karta? The existing unicorns will find a way out, right? But 18 out of the 30 unicorns that we have so far in this country have Chinese capital behind them. So who's going to create the next 50 unicorns? Which brings me back to the point that, do you know that if we are the only major economy that imports 90% of its capital in private markets, we are the only major economy. And going back to your earlier point, you said private versus public. I started investing in India 30 years ago in public markets. Until 10 years ago, Indian public markets were almost entirely dependent on foreign capital. Today, Indian public markets are substantially independent of foreign capital, and I would say domestic investors drive Indian public markets. There is no shortage of savings in India. There is no shortage of capital in India. What we are missing in India is a simple ecosystem of domestic fund of funds. This is where the government needs to take a step forward. It needs to seed 10 domestic fund of funds. It needs to create a domestic ecosystem where domestic savings can be channeled into private markets, because the issue here is not the current lot of 30 or 50 companies. The real question is, what about the next 300 or 500 companies? India's digital ecosystem, the way it's growing, its needs are going to be 5x of the capital it has consumed in the last 5 years. The next 5 years will require 5x that capital.
All right, so fund infusion has to be large, and the government measures will have to be supportive of the startup space. So this was about the Chinese bit, but we will understand more from the venture capitalists about what's really happening on the ground and which are the new investment destinations right after this short breather on Big Deal. Stay tuned. Welcome back. We are discussing the investment scenario in the startup space, especially after the FDI curbs on Chinese investors. Sudhir Sethi, now with a few disruptors in place in the startup space, with huge amount of cash being raised by one of the companies, it really taking up a dominant position. And on the other hand, Chinese investors not coming in, and we are looking and hunting for alternative pools. In this scenario, with the hit that the pandemic has had, on the overall sector and the business environment. How has your investor lens really changed? Which are the sectors or spaces which you are eyeing more and are looking more attractive than the others?
So let me answer that the question of a lot of money coming into geo quickly, and then I'll get to the second part. I think in every large country, and India is the third largest private market destination in the world, especially in the center being technology, there will be a large player, maybe one, two, or three, as has happened in the US and as has happened in China already. And the fact that Geo has got so much of capital has had significant rub-off benefits in the last, I would say, 2.5 months. Definitely, we've seen in our fundraising, we've seen in our portfolio, capital coming in overall. So I think there's a very positive spin benefit which has come to in the short run, overall. I think the other thing is in terms of the sectors which we are looking at right now. Significantly, we are a technology investor, and we continue to have a major change in that because we believe that there are so many challenges to be solved in the Indian market space which have not been solved before. These could be in supply chain, health, distribution chains. This could be in the whole space of agriculture, and those can only be solved by technology. If they were solvable not using no technology, they would have been solved before. So if that is the issue, then whether it is health, I mean, health is a very interesting area because there are a billion people who need health services. It cannot be done by the brick and mortar. Just to take one example, it's anywhere between 5 to 25 crores to create a birthing clinic. And there are the largest chain in the country, maybe have 20 of them. But you want to address a billion people and you want to address 25 million children being born every year, you need hundreds of these and you need them fast. It's just not possible with the capital. So how do you do that is a very, very big this thing. So technology will play a very big role. We are looking at deep tech solutions. In fact, our strategy has become even more deeper technology, whether it is in finance, fintech, whether it is in health tech, whether it is in software. The deeper you go in technology, the solution becomes simpler as far as consumption is concerned, whether it is B2B or consumer. And those companies are able to scale significantly higher. And I would just want to make one last point. The aggregate revenue of all our companies in March was about 7,000 crores, about $1 billion. And this is about 55 active companies. In the month of April, this fell 65% when the lockdown happened. It became $350 million. But fast forward to today, it's back to $1 billion. And big reason for this is technology. Big reason is technology because people have gone more online, people have gone more digital, and many of our companies have gone global. In fact, half our companies are going global right now. They become more profitable. So in some sense, entrepreneurs, entrepreneurs have shown their mettle in terms of getting back to normal or near normal in a very short time right now. So the opportunities, especially in online, digital, and going global, building companies from India for the world is very, very high right now. I mean, Lenskart is selling their products in the US right now. CureFit has already launched its services in the US. A small company like Emotix is selling consumer robots in the US right now. I can name them, and there are 24 of our companies who are now selling their products and services outside the country, which I never saw 3 years back.
So what COVID has done is really change the entire concept of geographical boundaries, and sky is the limit probably for most of our, at least companies in the virtual world. But Karthik Reddy, what is your headwind and tailwind analysis now, and how has it changed with the change in times?
The headwinds are obviously, things which are discretionary income oriented, right? People will take a pause and focus on necessities, especially in the local market. And it's probably true even in the global markets, which basically, to borrow from Sudhir's points, interestingly, I think everybody sees technology as a panacea and a solution for whatever is ailing in their business, right? And that could be, digitization of warehouses, productivity in large organizations, Kirana's getting digital, and consumers getting convenience, right? or for that matter, think of things which seem very simplistic and we never need a substitute for somebody's ability to go to a bank or go to school. Fundamental things in India are probably going to shape shift at a pace which nobody would have ever anticipated. And so I think the crisis brings these interesting opportunities from a tailwinds perspective in anything which is essentials driven. Because people are discovering, without even trying hard in terms of changing behavior, that you can learn so much more simply through the web. You can get healthcare at a much more interesting models delivered at home, much cheaper facilities. Financial services, right? I think this is like 10x the demon moment than demonetization ever was. Right? And so the ability to say that I don't need to see a person for 6 months and I can conduct business. This has opened the eyes of the 500 million Indians who are onboarded in the post-Geo world. And I think that is a huge domestic opportunity. And to summarize what Sudhir said in one sentence, Indian engineering talent was always a powerhouse resource that we had to sell great products to the world. The belief was not there. The unicorns have started kicking in. We hope, for good or for bad, if Trump continues to curb visas, the case becomes even stronger to build phenomenal Indian companies which can service the world. And I think that trend is going in that direction. We will build phenomenal SaaS companies in this decade, which will mimic what we did with the services companies. So decacons in that space are coming, in my view. So the idea is to take a 2-year forward view and start doubling down on all this.
Right. So Karthik, definitely we thought that demonetization was a big disruptor, but this has totally dwarfed the demonetization impact, and also the digital adoption is 10x more right now. In fact, there is no other choice. But Gopal Jain, final word to you then. How is the family office space really behaving at the moment, while cash conservation is also something that most of the companies and the corporates and business houses are looking at? On the other hand, there is a lot of opportunity right now also, those who have a forward view in terms of investment scenario and the returns going forward. So for the early stage companies, how is the family office behaving, and is there enough money being pumped in?
Well, I have only an indirect view of family offices. We are connected with 2 wealth management businesses. So if I look through their lens, I think what's changed in the last 5 years is that family offices now in India have real liquid assets, and at least some of them are starting to buy risk. I would say there's a huge tsunami that's coming the way of large investors in India, and which is there's going to be a mad scramble for yield. So yield is going to essentially there's a very good chance that yield will disappear from Indian markets, and this will create a huge challenge for family offices. Something similar happened in the US in the 80s, and that actually was one of the biggest triggers for the creation of the private equity industry. So over the next 5 years, I see private equity substituting some of the yield options that were available to family offices. And in that sense, if we can create the right channels, then a lot of this capital that's available with families, high net worths, will flow into India's venture capital and private equity ecosystem. Because why? Let me repeat again, because yield is going away. And so then the question is, how do you get yield? And the only way to get yield is to invest in alternatives. Yep. That's what I would say.
Right. So, Gopal, I've been hearing from the wealth management, fraternity also, that they are asking their clients to really diversify into the startup space and take off some money from the equity markets, which have been looking overheated for quite some time. So that's also one of the trends that I'm really looking at. But gentlemen, Sudhir, Karthik, Gopal, thank you so much for joining us. It was a great discussion, and we'll get back with more as things emerge and change at different times. So that was really the view coming in from the venture capitalists. Definitely, the investor lens has changed in changing times, and we'll have to see how different pools of capitals make their way into the startup space. But the ethos of investing really remains the same. What is that technological solution that you're providing, and whether it's easily replicable or not? With that, thanks so much for joining us on Big Deal.